There have been a lot of earnings calls recently and just as many dividend cut announcements, or at least it's felt that way. We've had everyone from Rio Tinto here in the UK cutting their dividends to Intel in the US slashing their dividends by 66%. Dividend cuts are usually a warning sign and they're a sign of trouble to an investor, and an investor should definitely look into them in more depth. But there are some situations where dividend cuts may not be as bad as they seem. A dividend cut occurs when a company that usually pays dividends decides for whatever reason to reduce the amount of dividends they're paying out to their shareholders. Or in some situations, they might completely stop paying those dividends altogether. And these dividend cuts can be done for a variety of reasons, good reasons and bad reasons. So we're going to take a look at a few. The first one is due to financial difficulties. And this is probably the most common reason as to why a company may decide to reduce or completely stop their dividends. During difficult times, companies may start seeing a decline in their revenue. And due to this, they may have less cash flow to use to pay dividends. Instead of that company taking on a lot of debt to cover their dividends, they may just decide to cut them back to an affordable amount so that they can carry on paying, but less of them, or they may decide to just stop them altogether. If a company does not have a healthy balance sheet and you see them cutting their dividends this year and then in 2 years' time and then in 3 years' time and they're up, they're down, they're not consistent, then this could actually be a bit of a warning sign to an investor. Because at the very core, you kind of want a company to have good fundamentals. Now, there are always exceptions to the rules in everything in life, and a lot of companies actually did have to cut their dividends in 2020. But some of these companies had never cut their dividends before, or at least not for decades before. And I think in circumstances like this, you need to just dive a little bit deeper, because initially you might panic that that's a bad sign and that they're experiencing bad fundamentals. But actually, that was kind of an external factor outside of a lot of these companies' control. And yeah, I don't think that necessarily means that they're a bad company, as long as they can rebound from that and get back up on their feet. But definitely something to look into. For example, we had Disney. Disney was one of the most popular dividend paying stocks, and in May 2020, they stopped their dividends altogether. And that was because the pandemic really affected their business. Obviously, quite a big portion of Disney's revenue. Now they have lots and lots of revenue streams, but one big portion was their parks, and they all had to completely close. And that resulted in a net loss of like $2.8 billion. So they made the decision to stop paying their dividends whilst this was happening. And actually, you could view that as, yes, it's a bit annoying as an investor, but also you'd probably rather them stop paying the dividend and get back up on their feet than actually taking on more debt or letting the company go under further. However, what we've seen with Disney is that since the economy is reopening and they can open back their parks and their resorts, they've actually recently announced the reinstallment of their dividend in the last earning call. Another reason is the company's performance. If a company's not performing very well, they may decide to reduce or cut their dividends in order to get some extra cash that they could then use to actually reinvest into their business and boost their performance. The next reason is debt. Cutting dividends reduces the amount of cash that a company needs to give out to its shareholders. And this then frees up some cash that they can actually use to pay down debt. This is a really interesting one, and there are lots of things that come into play with this. But if a company is seen to be quite a good company, but perhaps they've taken on a bit of debt and they decide to reduce or cut their dividends in order to pay that debt, then one could argue that they're actually prioritizing their financial stability, which of course is beneficial for the investors in the future. But like I said, it's not just normally as straightforward as that. This can also trigger investors to panic, which in a lot of cases with dividend cuts, they're in their right mind to do so. But then they go on to sell their shares, and there's often a big decline seen in the stock price after a dividend cut is actually announced. Another thing about a company reducing their dividends in order to pay their debt is that it may actually increase their creditworthiness, making it easier and less expensive for them to actually borrow money in the future. And this then may lead to them being more flexible financially and being able to pursue growth opportunities in the future, or perhaps weather economic downfalls a little bit better. The next one is changes in their business strategy. If a company is changing its business strategy or investing into new projects, they may decide to actually cut some dividends in order to free up some capital for some growth initiatives. This can include mergers and acquisitions, more money into operations, more money into research and development, that sort of thing. And this can actually be seen as a good thing sometimes because it may allow them to grow quicker, it may allow them to be more competitive in their industry, and it may allow them to become a better company in the future. And I think it's this real delicate balance between being a dividend payer where you can sustain your dividends and experiencing dividend cuts in order to grow the business. Because that's one argument against dividend investing, right? That a company is actually using their money, their cash to pay dividends instead of letting themselves grow. So I do think it's this really hard sort of seesaw that they do have to balance on. The next one I've kind of already touched on, but it's unexpected events. Unexpected events can mean a variety of things. It can mean what we've already seen in terms of the pandemic, where companies were kind of forced to stop their dividends for X, Y, and Z reasons. It can mean natural disasters, it can mean political problems that also we're seeing right now. It can mean anything outside of the direct control of the company. Because obviously all of these things can have a massive impact on the company's operations, cash flow, and profitability. Think about during the time where China had to shut, and a lot of these companies actually manufactured their goods in China. That is going to have a massive, massive impact, and perhaps they would have had to turn and look to cut money where they could. One of them things could have been dividends. Sometimes dividend cuts can be a true negative indicator, a real sign that a company's fundamentals are perhaps poor and that they're experiencing bad financials. However, sometimes they can actually be the best choice management of a company can actually make for the investor, for the shareholder. Sometimes trying to maintain a dividend payment over a long period of time can actually make it worse for the investor in the future rather than them temporarily cutting the dividend in order to put that money elsewhere. Of course, the best case scenario here would be a dividend company that is able to consistently grow their dividends time and time again, like the dividend kings and like the dividend aristocrats, because that normally indicates to us as an investor that the company is not only able to pay a good dividend, but they can do it year on year on year, whilst still being a company that is able to grow and has good financials. Because that means that exactly that, they have good financials. They have a balance sheet that can actually support this continuing paying of a dividend and growing it as well. So I think when you see that a company is going to be cutting its dividends, there are a few things you need to think about. You need to find out why. You need to ask yourself, why are they cutting their dividends and how is that going to affect me as an investor right now and in the future? And what does that say about the company? Was it something outside of their control that's happened once in a blue moon? Or is it something that keeps happening and actually you need to dive deeper and see what's going on in their fundamentals, in their balance sheets that is causing this to happen? Because you don't really want to be investing into a company that have poor fundamentals. Obviously, it's your choice. This is not financial advice, but those are some things that I would really think about. If you're wondering why I'm wearing such a cool t-shirt, it's because I am. This t-shirt says Eat, Sleep, Invest, Repeat. I designed it myself. It comes in 6 colors. I'll leave a link in the description if you want to look as cool as I currently do. And if you're interested in joining my Patreon, where you get access to a Discord channel where we chat about investing, personal finance, we share resources, share our portfolios every single day, then again, I'll leave a link in the description. But I just wanted to make this quick video to talk about dividend cuts and why they may be good, why they may be bad, and just because they've been happening a lot recently, or at least it feels that way. If you've got anything to add to this video, drop it in the comments below and I'll see you again very soon.